Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio. "26 years of CNBC-TV18.
The benchmark indices of South Korea and Japan, respectively, trading with gains of over 1% each.
Could make a landmark and historic trade deal that would be to the benefit of both peoples.
The 20-day for the Nifty is at 26,021, and we are, of course, under it as of yesterday. Nifty Bank is starting with about 1/3% gain. That's about 190 points.
Broadly, on industrials, we like the space because the government's focus on creation of infrastructure, we think, is likely to continue.
Right, we are only 1/3 of the banking industry today, and our products are reasonably good for the final investor.
It has been a 4% of a gain overnight, and this is trading at an all-time highs of $64.32.
The shift is happening gradually from backhoe loader to the mini excavator because of the advantages which the product category enjoys.
Sergio Gore, the incoming US ambassador to India, has given more flavor to the negotiation.
We have 1,800 stocks which are advancing as against 900 stocks which are declining.
The reasons apparently are a spillover from yesterday and today.
The outperformance in mid-caps is something that we are tracking very closely.
Good-looking screen, good-looking Friday, 135 points higher. That is the latest rate on the Nifty. 26,030 is where we are at. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Reema and Surabhi. Good afternoon.
Hi. It is turning out to be a Friday, right? That's what Reema said in the morning. And in the morning, we were complaining that this phone call is not causing any excitement. But I think now it's been slow and steady. So touch wood. So far, so good.
And market breadth is good. 2:1. Actually, for the second day running, the market breadth is better. And even the composition of what is moving up. Yesterday, actually, the problem was market breadth was better, but they were kind of random, stocks. You don't really show up. They don't show up on the screen, not well owned. But today, it's a much better, healthier, deeper kind of, broader market strength. So that is good news as well. Just the kind of stocks which are moving up is good to see. So of course we'll talk about individual names. So let me just quickly actually tease out what's coming up here over the next 60 minutes or so. So you've got markets which are very much, of course, in focus. We'll have 26,000, which is back on the Nifty. Metals are leading the rally. Real estate counters are, of course, also following closely behind. Mild pressure seen in FMCG, PSU, bank counters. Siemens is a stock we want to focus on in a bit. So they are now pegging Digital Industries margin between 6 to 8% as opposed to 12 to 14% earlier. Stocks down 4%. And management is highlighting a largely muted trend in private sector capex, making it tough to peg sustained momentum following that pickup in the months of November and December. There's a brokerage upgrade on Goldman on L&T, and the stock is up about 2%. As we are coming in, I think there's also CLSA, which is talking about Dixon. Dixon is the other one, which is also up about 2.5% the last I checked. That's the lineup. There is, of course, the CNBC-TV18 exclusive, which we will get with Yash as well, which is a big one, actually, for insurance companies and especially on the distribution and commission side. Names like PB, etc. should be in focus. So that's the lineup here over the next 60 minutes or so. How should you position yourself is the question. Mitesh is with us with that insight. Mitesh, good afternoon. Good to have you here. Comfortable going with long positions into this Friday?
I guess very much, Prashant. The idea is that one, we are above that exponential 20-day averages, etc., which are at about 25,950, 940 levels, and sustaining about that. We've held the day well. So I think, we might actually be heading towards 26,200 in a good case scenario, the recent all-time highs of 26,325. So these are the two targets on the upside. Though I don't have a clear sign of a breakout as yet, I think, a retest looks very much on the cards. On the stock side, buy on Dalmia Bharat. I think cement stocks are doing well, and That's where, some kind of reversals are happening from support levels. So Dalmia Bharat is a buy with a stop at about 2030 and a target of around 2150. And the other stock which I have on the buying list, just a minute, I think, is Aurobindo Pharma. Aurobindo Pharma also, after a pullback appears to have reversed. So buy here with a stop at about 1180 or just below it, and target of 1240 can be looked at.
Mitesh, just one more name. Hindustan Zinc is the #1 volume-led gainer on the NSE. It's taken out its June high, June 25 high, which was about, I think, 540, 545 or so. Stock's at about 562. It's a breakout you can trust. Is there a trade here?
Hindustan Zinc, has been a recommendation of mine. In fact, the breakout is very much on. Yesterday, we kind of booked profits, and that's on the sister channel of yours, which is Money Control. A target of around 530 to begin with. I think that's been met, and the stock continues to rally. I think, very good chance that this rally could see possibly stock head towards levels of around 610, 615, which is where, we had an intra-week pivot at in the month of August of 24, and then even 660. So I think very positive still. And now I think, the way to buy is to wait for some kind of pullbacks to happen and then buy into this one.
Yeah.
Okay, by the way, some more counters doing well. So with Hindustan Zinc, even Hindalco and Nalco have hit fresh all-time highs. In fact, the entire metal complex, the metal index is up 2% so far this week, outperforming the benchmark indices by nearly 2.5%. So that's a pocket doing well. And EMS companies like Akanes, that's up 5%. PG Electroplast also seeing short covering for the second consecutive day. And capital market plays. The capital market index was up 1% yesterday, and it's followed it up with more buying today. And the Nifty capital market index has gained another 1%.
Yeah, absolutely. And some of these names on the metal side, even something like a Hindustan Copper, because the conversation in markets now has come around to how copper and aluminum are likely to sustain their positive trends, just in terms of pure industry dynamics, demand-supply dynamics. And that seems to be having a big rub-off effect. And then, of course, there is the silver rally that's helping something like a Hindustan Zinc. Anyway, some more names. Keep BHEL on your radar as well, with a couple of these brokerage upgrades that came in. Some of the industrials, BHEL, Thermax, L&T, a lot of these stocks are having a good session as well. And we'll talk more about it as we go along. But now, as promised, let's get you that exclusive story. Sources are telling CNBC-TV18 that the life insurance industry is working on a way to cut distribution and commission costs. Let's go to Yash. Yash, what exactly are you picking up? Because we know that commissions, in the insurance industry are very high compared to, say, the mutual fund industry. So what exactly is being considered now?
Well, that's correct. The difference is quite huge when it comes to the commissions in the mutual fund industry versus the insurance industry. And what we've been given to understand is that the chairman of the insurance regulatory body, that is IRDAI, had separate meetings with insurance companies, life insurance CEOs as well as general insurance CEOs. And at both forums, one thing which was made very clear to the CEOs is that the insurance commissions or the distribution costs continue to remain very high in both life as well as general insurance industry. In fact, he had asked for both sides of the business, that is general as well as life insurance industry, to give views in ways in which distribution costs and commissions could be brought down. Both sides of the industry have moved towards doing that exact same thing in terms of suggesting ways in which insurance distribution costs can come down. Speaking about the life insurance industry first, what we've been given to understand is that the industry has formed a 9-member committee on ways to bring down commissions as well as distribution costs. This particular committee of 9 life insurance CEOs met and in fact had the first meeting just yesterday, where a series of measures were discussed in terms of how these commission costs can come down. But there was one measure which was which found the vote of confidence coming in from all CEOs unanimously, and that was to take the IRDAI's approval towards moving on a deferred commission model. Now, currently, it is all about front-loading commissions. I'll give you an example. If it's a term life insurance policy spanning across 20 years, the first year of the policy, the commission will be about 40%, and then second year, about 5%, third year, 5%, depending on the renewal. What the insurance industry seems to be suggesting and wanting IRDAI's approval is to split that 40% itself across 5 years, which means just 8% in the first year, and then only if the policy gets renewed in the second year, then another 8% and so on. Otherwise, stop at that 8% itself. The insurance industry is likely to give this suggestion to IRDAI on December 18. The next meeting is supposed to happen next week, where the industry would discuss details and final regulations of this deferred commission policy.
Got that. Yash, thank you very much for that. So that is live, right, Yash, in terms of the deferred commission, which is being proposed. So life insurance, this committee is proposing it. They'll have to take it up to IRDA, and it's up to the IRDA to approve it or not.
Correct.
But as you said, there is consensus. It was a unanimous suggestion in that sense. For general insurance, which includes, of course, health insurance as well, I mean, there is also the sort of same kind of pressure from IRDA to lower commissions. So what's the plan here?
Well, Prashant, as I said, both sides of the business, the life and the general insurance industry, have moved in their own ways to look at reducing commission. As far as general insurance industry is concerned, the regulator had a meeting with the CEOs there as well. In fact, I've been told by my sources that the IRDAI chairman himself made a presentation to the CEOs presenting how the distribution cost or the commission cost is very, very high despite the GST changes, and them being adjusted in the commission. It still remains to be high according to him. And there were various suggestions which were given to the IRDAI chairman. One of them was listing companies and asking them to list, but according to the chairman, that wasn't a viable suggestion. But one suggestion which came from a few CEOs in the same meeting was that first thing, penalize the companies which are currently, doing above the expenses of management limit, which is 30% for general insurance companies and 35% for health insurance companies. And second thing, for vintage companies or old companies, essentially companies which have spent more than 5 years in business, the EOM limit should be brought down by about 500 to 1,000 basis points, taking it from 30% to 25% or 20% for general insurance companies, and 35% to 25 to 30 or 25% for health insurance companies. Bringing down the cap on EOM limits would itself, according to the industry, bring down the underlying distribution of the commission costs.
Okay, Yash, thank you very much for that. So, message is clear from the regulator. I mean, they want this done. Lower distribution, lower commission costs, and better pricing for buyers of insurance products. Dharmesh Kant is with us, Head of Research, Ola Securities. Dharmesh, it's good for, of course, insurance companies if this gets done. Of course, it's bad for distributors. Any stock implications as you see it?
Yeah, good afternoon, Prashant. I mean, PV FinTech will react negatively to this kind of a news flow. And already there are too many push and pulls happening around the insurance segment. So eventually it's good for, insurance companies, definitely, yes. And even good for consumers of insurance products. So as a basket, we have always been recommending insurance company, and there our topic remains LIC Life Insurance Corporation of India, followed by SBI, HDFC, and ICICI Pru Life. So this basket, I mean, you have to play out with for a long-term perspective. Insurance, only the caveat is it's not a trading play. It's not 1-2 quarter kind of a play. If you are getting into here, then please stay invested for 3 to 5 years to have a meaningful returns.
Okay, all right, got that. Dharmesh, stay on. More questions coming your way. Like I said, today there's plenty of news on industrial stocks. There are brokerage upgrades, and then there is Siemens, which is in focus. They held an analyst day. Let's find out what the takeaways are. Vinny, run us through.
Hi, good afternoon. So Siemens, first in terms of the key takeaways, overall, they're seeing private sector capex. That has not seen as much of a uptick as one was expecting. Still muted. November, December, though, there are some green shoots that have come in, but it will be key to watch out for in the next 5-6 months whether this continues. And it becomes an important part for them because the digital infra side and industrial side of their business, which accounts for 20-25%, it's largely dependent on this private sector capex as well. So that is key to watch out for them. Apart from that, they've said electronics, battery manufacturing, solar cell, pharma, all of them are doing well in terms of an uptick or demand there. Digital infra DI segment, like I said, that is something where they said the margins are expected now to be in the range of 6 to 8%. Do not forget, in the September quarter number, which they reported as well, the margins were almost in that 7-8% range itself. But versus last year, that's come down, right? It was 12-14%, and now they're expecting the 6 to 8% range. So it seems like analysts were not too happy with that situation. Other than that, what analysts are highlighting that the motion segment, they believe margin expansion will be seen there, 9.5 to 10% range over there from currently 7.5% going forward. But the concern over there, or the challenge that comes in that segment, is one in terms of high inventory build-up that is there. They are expecting some delays that could come in from the Indian Railway side, and the company is reviewing and re-evaluating their capex plans on that front. So that is something that is a bit of a concern that analysts are highlighting going forward for the company. So that is the second challenge over there. And the third one is that the company has not given any guidance this time in this analyst day. So the street is not too happy with that situation, and that is why the stock has seen a fall. Overall, the smart infra side of their business, which accounts for 53% of their revenue in FY25, there the analysts have highlighted that they're expecting high teens to 20% growth. So not a concern on that front, but the DI segment and motion segment, a bit of a concern that comes in there.
So DI is 20-25% of the overall revenue. And what about the motion?
Same, 20-25 in that range approximately. So motion and DI account to 50% of their business, while smart infra side is the 53% of their range.
And smart infra is okay?
For smart infra, there is nothing in terms of a cut there. But the DI segment, and the concern comes in that the motion segment, you may not see that much of railway orders or re-evaluating the capex plan, is that worry that has come in there.
Okay, thank you very much for that. Ramesh, did anyone in your team attend the Siemens Investor Day, and what were your key takeaways?
Yeah, Rima, one of the analysts did attend the call, and there are too many analyst calls happening these days. And the problem with most of the analyst call is, and none of them are giving the guidance or the future outlook. They are just talking about the general business as on ground, and that is not very, very encouraging. That's the takeaway which is coming. Siemens quarter results were bad. Even ABB was not that great kind of a result in the Q2. And the railway infra has been a concern. Last 2 years, even the railway budget allocation has not been there. Execution has been a problem. And we have seen that kind of a result trickling into, say, Incor Infra, Incor International, for example. If you see the results, they were not that great. Execution has been a problem. Private capex on the power renewable and thermal both has been seen a problem. Government has 43 gigawatt of renewable power capacity is put under scanner. So that again clouds the future growth trajectory. At the same time, thermal, the pace of expansion has not happened the way it was likely to be there. So basically, in Siemens, largely cater to these kind of sectors. And 50% of your business, if it's not doing well, it's always a concern. So, I mean, the better part is to stay away till, this there is a pickup in the general economy. And this, if you corroborate with, nominal GDP growth of 8.7%, GST collection of 0.7%, and IP growth of 0.4%, followed by factory output 3.7%, all falls into one line that the infra economy, the infrastructure side, is not doing that well. Maybe a part of consumption has picked up, but it's not a 360-degree kind of a view on the economy which has been doing well.
Which other company held their investor day? So Coforge comes to my mind, but it's not that this is a company which gives annual guidance. It's just that last time they gave a forward-looking, big picture, the opportunity kind of a guidance. This time they did. So Siemens is one. Coforge, you could add that. Which other company hasn't given a guidance, and that's disappointed the street? And what does it tell you? That these companies do not have the revenue visibility, or the environment is volatile, uncertain, which is why they're hesitating from quantifying the performance. Is that a bit of a worry, and is that across sectors?
Yeah, I mean, couple of sectors like Welspun Corp, we had a management interaction. We have a Power Mac Projects Limited, we had a management interaction out there, and they all are, looking for new opportunities of the business line rather than the business line which is already there. And they are saying that they would be able to do, early 20s kind of a growth trajectory, but that confidence and putting a number to it was not there. Translate Lighting is another company which we have interacted recently. Again, the same, case study was there. And one of the IT companies, Orient Pro, had a product launch a couple of days back. There also, the gung-ho nature of 30% kind of a CAGR was missing in the interaction. So generally what we are seeing is more of a rounded kind of answer rather than a very aggressive and a bold answer, which is expected in line of the tailwinds which have been there in the economy, the macro tailwinds, the so-called like interest rate cut and GST cut, direct tax rate cut, good monsoons, everything playing out, per capita income rising. That is not very palpable when we are interacting with particularly the industrial side of the economy.
Audinpro was one of your picks. Have you changed your view after that call? No.
No, Prashant, we have not changed the view out there. The only, as far as putting the number part is there, it was missing this point when in our last interaction. But there, verticals are stacking well. I mean, the entire banking suite is doing pretty well, and followed by, that data center infra play. So couple of orders are expected. So, let the announcements come, then we can talk more on that.
There was just news, by the way, at the bottom of the screen. The cabinet, and this was expected, the insurance amendment bill has received cabinet approval, which means that now it will go to the parliament for the parliament to clear it. We've, of course, reported extensively on what is part of the insurance amendment bill. And maybe we can sort of, revise some of the stuff with Yash. There's, of course, the FDI bit, but there is, open architecture for agents. The
composite license, was it a part of this?
Composite
license was a part of this.
Yeah. Basically, everybody can do everything.
Everyone can do everything, yeah.
It's open. So actually, those are the three big ones.
So FDI is one, composite license is two, and the third one is?
Agents can sell anyone's policies, no longer tied up to only one insurer, which is very huge. It's landmark for the...
Especially for LIC, because LIC is dependent on individual agents. But they could only sell LIC policies. Now they're free to... Sell. So it's not great news for LIC, actually. I mean, if there's one company which maybe, I guess, stands out in a slightly negative way, is this one. Because of course, what's being done. Now, more on this maybe we can, insurance we discussed with Dharmesh, but maybe we can get Yash back on. But JSW Energy is raising money. Vivek is here with some perspective on this. Vivek, take it away.
Well, JSW Energy has been in the news. Last week, you saw a significant block deal take place where GQG Partners exited a pretty significant chunk of their holding, via a block deal. Also, the company had given a notice to the exchange saying that they were evaluating a fundraise. So today, a whole raft of decisions has also been approved by the board. Number one, important KMP, Chandrasekharan Prabhakaran, who was earlier deputy CFO of JSW Steel, will now take over as the CFO of JSW Energy from Jan 2026. This was due to the fact that Pritesh Vinay's resignation actually created this particular vacancy. Now, along with that, there are three important fundraisers that the company is talking about. First one, they have approved a fundraise up to 10,000 crore rupees. This is likely via the QIP or a private placement route. It's pretty significant. However, JSW Energy has been pretty ambitious in terms of going ahead and raising capex, especially in the RE capacity side. Also needs to be seen whether any inorganic acquisitions are at this point of time being considered. So that is the first part as far as the fundraising is concerned. Now coming to the second part, they are doing a preferential issue. This is via equity shares up to 500 crore rupees to a promoter entity, and the price for this particular equity issuance will be at 525 rupees a share. Along with that, they are also doing a preferential issue via warrants. These are convertible warrants. This particular amount could be up to 2,500 crore. And again, the convertible price for the warrants will be at 525 rupees a share. Whole draft of decision, significant fundraise activity is being planned by JSW Energy.
Thank you very much for that, Dharmesh. JSW Energy fundraise of 10,000 crore. There is a new CFO, a preferential issue warrant. I guess the bigger news is the fundraise.
Yeah, see, if you look at the price of the JSW Energy, we had an IC a couple of years back, and based on that, we had a price target of 520 rupees on that. So it has, breached that. It went far higher to that, and then it has corrected. So these estimates, based on FY28 earnings estimate, the best price of the JSW Energy, which we have been accounting for, was around 520, 530. So not much of an upside left here from the current price levels. But yeah, if somebody is looking for a trading opportunity, they can go ahead. The good part about JSW Energy has been the execution has been quite ahead of the times. So whatever capacities they have been, saying about, that has been, commissioned much ahead of the time, and that is adding to the value. So largely, it's a good theme into the power sector play. But power as a space, entire power sector space, because the stock price movements have been so sharp that the valuations are far ahead of the earnings growth trajectory. So that's the caveat which one has to keep in mind.
Okay, thank you very much for that, Ramesh. Happy Friday to you, and I hope you enjoy your weekend and look forward to chatting with you next week. By the way, Hindustan Zinc, the rally continues there. It's 8.5% higher, and that flash about silver. Silver has now crossed 2 lakh for 1 kg. In dollar terms, I think it's $64 plus for an ounce. I think a couple of days back, Manisha was telling us that it's more than doubled, and silver, on account of its investment value plus industrial use, has found a lot of favor with investors. And just recently, I was reading an article that silver-backed exchange-traded funds have seen the biggest inflow since 2020, and that pretty much ties in with the kind of price rally that we've seen. That's the level on there you have it, 2 lakh. For 1 kg of silver, and Hindustan Zinc is the clear play, and Hindustan Zinc week-to-date rally, I think, would have crossed 15-16%, maybe even more now, but 8% has come in just today.
Absolutely. I mean, it was gold first in the first half of the year, and then silver caught up, and there's no looking back. I mean, it's astounding what these commodities have done. Both on the precious
to the rest of the base metals also.
It's going into copper, it's going into aluminum.
Yeah,
a lot of chatter about how capacity is going to be limited. China is no longer dumping, aluminum in global markets. So the expectation is they will not do much of that in 2026, and it's really been driving the entire metals complex. We will discuss this with our next set of guests, but right now it's time for a quick break. Prashant caught up with Ramesh Damani, and we will get you his views on the multi-bagger journey in the market on the other side. Stay tuned for that.
Welcome back. Let's put the spotlight now on the top movers in the market. Hormus is now joining in. Hormus.
Well, there are certain mid-cap and small-cap names that are actually having some Friday fever today, and actually Friday fervor, if you would like to call it that. Metal names have been the headline of the week, actually. And look at these names. The silver prices at record highs, copper prices at record highs. Hindustan Zinc is at a 52-week high. Hindustan Copper is at a 52-week high, as is Nalco. You look at the gains, anywhere between 6% to 8% in today's session. The volumes in all of these names are no different. 3 crore shares traded on Hindustan Zinc, 4 crore shares on Hindustan Copper, 2 crore on Nalco, and unsurprisingly, all of them are significantly above their 20-day average. So gains coming on very strong volumes as well. Camlin Fine Sciences is the other stock on the list today. It's the biggest single-day gain that the stock has seen since May, this 15% up move. The best week that the stock is supposed to have in nearly 3 months. The 20 lakh shares have been traded on the stock today. The 20-day average of just around 2.5 lakh shares, around about 8 times the 20-day average. It's trading, despite this move today, the stock remains below all key moving averages, with the next level on the upside being the 50 DMA, which is at 177. And the stock has run up around 28% so far in 2025. And this 30% up move is turning out to be the best year the stock has had since 2020. Anant Raj is the other one. It snapped an 8-day losing streak earlier this week and is continuing to build on to those gains. 9.5% higher now on the stock, and the biggest single day gain and volumes that the stock has seen in the last 3 months. It had more than 1.5 crore shares that have been traded, the 20-day average of around 21 lakh shares on Anant Raj, and it's back at its 200-day moving average of 553. And despite this move, the stock is set for its first year of negative returns after 2019, with this 36% fall that the stock has had so far on a year-to-date basis. And lastly, transformers and rectifiers, the biggest single-day gain since January of last year, this 14.5% up move. It snapped an 8-day losing streak this week as well, the highest volume since its listing day, and the listing day goes all the way back to 2007. We had 4.5 crore shares that have been traded on the stock today, the 20-day average of just around 35 lakh shares, but remains below moving averages and is down 53% so far this year, and similar to the previous name that we highlighted, the first negative year for the stock after 2019.
Oh, what a buzzer. 15% up today. As usual, Hormaz picking out some of the most interesting movers and shakers in the market. Thanks for that, Hormaz. Well, let's get to that promised conversation at the launch of the 30th edition of the Motilal Oswal Wealth Creation Study. Prashant caught up with veteran investor Ramesh Damani and spoke on a whole range of issues, including Mr. Damani's investing hits and misses. Listen in.
When we introduced to Buffett, I always find that very fascinating because you all are Buffett fans. Ramdev said 95. In 1977, I went as an MBA student to America to study from MBA. I'm actually old guy, so I went in 1977. And most people going to Los Angeles in those years would tell the local hosts, take me to Disneyland, take me to Hollywood Walk of Fame, take me to, you know, the tech industry, whatever. I remember telling my sister to drive me to the See's Candy store. There was one See's Candy store in that area, and there was one Walmart in that area at that time in 77. So obviously I'd heard about Buffett. I don't know how, but even when I was 20 years old, I'd heard about Buffett. But it took me until maybe 85, 87 to kind of understand that this guy was actually something extraordinary that he was doing.
This is 77 when you kind of...
1977,
wow.
Yes.
And he'd kind of migrated away from what he used to call cigar butt approach to kind of buying high quality stuff.
Yeah,
that had already happened. I mean,
no, it happened much later. He bought Cap Cities in 1985.
Right.
And I know some uncles that bought Berkshire Hathaway stock, and they told me they bought Berkshire Hathaway. But in the 87 crash, they had sold it.
Right.
And then they were very happy because it had gone down from $3,000 to $2,500. And today, of course, it's some other number. So let's not discuss that pain.
Which, I mean, it's a much abused word, but multi-bagger, best, I mean, you know, great compounder in your career, best captures the power of it staying invested through cycles?
I mean, there are a lot of stocks. India has given us such a great opportunity. Sometimes I feel like hitting fish in a barrel because there's so many multi-baggers and compounders. It's actually unbelievable how many multi-baggers you got. But the one that I think that people don't know and I think they should study, in fact, I would urge Ramdev to do a special study on that because it's created that kind of wealth, is a company we bought in 96, 97 called Bharat Electronics. I bought it after it IPO'd at 40 bucks. It went to 20 bucks. At 40 bucks, it had a 5% yield. At 40 bucks, it had a 5% yield out there. I think, if I'm not mistaken, if you bought 100 shares, I think they're worth 25,000 shares today by splits, bonuses, whatever. And for 400 rupee price, that's about 1 crore worth of investment. It's about 28, 30% compounded over long periods of time. And to address a more fundamental question, Prashant, people often say, oh, gold has beaten the sensex and all this kind of nonsense I keep hearing from people. Now, here's the fact of the matter, that when you buy a securitized asset, as Ramdev has pointed on the study, not only do you get the splits and bonuses, but you also get dividends. So if you had bought an ounce of gold in 1980 at $1,000, today it's $4,000. All you got is the price appreciation in the gold. If you bought Bharat Electronics or HDFC Bank or Reddy's or Apollo Tyres or whichever stock there, the splits bonuses would have increased your value dramatically. The P ratio would have inflated your wealth. And the dividends would have added extra 2-3 percentage points of return. So I think people conveniently tend to forget that. I think over 150 years, I think gold's given 3%, equity is given 11-12% without dividends. So you know where you should put your money.
Something that you wished that you had bought or you owned it at one point, you sold out early, and then you look back in hindsight, you say, well, that was the wrong thing to do.
Yeah, Prashant, I have enough thumb-sucking experiences to describe. And I think the one that Ramdev got and I missed, which is no excuse because it's in my circle of competence, it was in my backyard, it was with people who ran the company who I greatly admired, and yet for some reason I was sucking my thumb when Bajaj Finance got listed. I mean, it's just something that I really tell. There's an error of omission, what do you call it? You know, nobody questions me because I'm a prop investor, but I know the hurt of missing a stock like Bajaj Finance. I don't mind missing a Reddy or missing Apollo because those are not my circle of competence. But to miss a Bajaj Finance was extraordinarily stupid of me. In my backyard in Pune, I go there like 3 times a month. You know, I could go and visit any time. I made a mistake there. I rectified the mistake during the COVID. I bought some there. But it was a different feel. I should have been at the get-go.
But why didn't you? I mean,
I just missed it for whatever reason. Complacency, didn't do my homework. The fault all is with me, nobody else. I mean, I just didn't do my work. I should have done the work out there. You know, for whatever reason, I was, busy trying to make 10% gain, 20% gain, and miss the multi-bagger opportunity of a lifetime. Till today, it still rankles me.
Thanks for sharing, Mr. Damani. Anything you bought and you sold out, which you wish you did not? I mean, I'm sure there are many, but any one kind of...
I tell you one thing. During COVID lows, I'll give you a good interesting example of how this thing works. I had bought a stock at 20 rupees a share in 93. The right issue had come at 20, I had applied for the right, I bought it at 20 rupees a share. And I held it unchanged until 2020. So whatever period, I think 25 years, they're unchanged. Didn't buy anymore or sell anymore. By that time, the stock had become 1,000x, no, 100x. From 20, it had gone to $2,000. $2,000, right? In COVID, I was a bit nervous. I wanted to sell something, and the year was something I was making 100 times my money. So I sold those shares. I said, "ठीक है, कोई बेच दो." I think in the next 6 months, it doubled, then doubled again. So if I waited another year, I would have sold it at maybe 700x instead of selling 100x. The stock, for the record, is Apollo Hospital. I made 100 times the money and I sold it. Why did I say? Just because I made too much money and no other reason to sell it. I was nervous. I wanted to create some cash, so I sold it. But I missed out on one of the great compounding stories in this market.
Which stock?
Apollo Hospital.
Apollo Hospital. Wow.
But you know, the second example, one is you didn't buy. The second you bought, but you maybe sold out early and you should not have.
Because I made 100x my money. I mean,
absolutely.
That's no reason to sell.
Absolutely. Mr. Damani, how much weight do you put, sir, on sectoral tailwinds, high ROEs, some of the things that Ramdev said when you are looking at opportunities?
Yeah, Prashant, Ramdev had this formula QGLP. The one I focus on quite extensively first is P. I'm very concerned the price discounts everything. So more than leadership, more than ROE, more than P, I'm looking at the price I'm paying for it. Sometimes even if I make a mistake, the price is the cigar butt example. You can still make money out of it out there. And generally I find that if you buy when a bull market is starting, an extremely underloved sector, which means the price is very, very cheap, you'll end up making a lot of money at the end of the bull market out there. So almost obsessed. If you ask me about a company or pitch a company to me, almost my first few questions will be what is the market cap of the company, because that gives me a good starting point. Is it 500 crores, is it 5,000 crores, 50,000 crores, you know? And can I value or see the business at that market cap? So for me, it's P.
And P and of course the market cap relative to the size of the opportunity. I mean, how much?
As I see it, as I see it. You know, if they're in a commodity business, I know the market cap should be this, consumer business should be this. But the market cap is an amazing filtering exercise, you know. Some business I will not look at no matter what, because the market cap is too big for me at this point, for me to understand.
What a phenomenal conversation. I'm sure you want to catch more of that, and you can do that on our social media handles on YouTube as well, on the mistakes and the learnings from those mistakes, as well as, of course, the wins with someone as deeply entrenched in the market as Mr. Damani is. Well, with that, let's get back to the here and now and see what the screen is telling us. And it's still a nice bright shade of green, 150 points up on the Nifty. Let's see what's been going on in the F&O market. Maglam, what are you picking up?
Well, it's a bright shade of green indeed in the F&O market as well. We have the Nifty, which is doing well. The Nifty Bank is leading it. At the same time, we have the mid-cap index, which is doing well as well. So all three factors of the market holding fairly well. The interesting part, however, is right now the Nifty is above the 20-day moving average. Closing above that will be extremely crucial, because all through this week, we've been oscillating between this 50 to 20-day moving average sort of zone. Nifty's 50-day moving average was closer to the low that we saw on Monday. 25,717 is where it is right now, and on the way up, upwards of 26,024 is where the 20-day moving average is. So where we go from here, how does it close, will determine the course of next week. And also at the same time, we'll be keeping a quick eye on the India VIX, which over the last two trading sessions has been coming down. The advanced decline is a firm move in favor of gainers. So the green line fairly above the red line. All these factors generally will make bulls feel good as they go home for the weekend. Amidst all of this, the metal stocks, they are shining today. If there was one genre that, of music that the bulls would be playing today, would definitely be heavy metal. Tata Steel, Zinc, Hindalco, all of them doing well. And add to this, for the index, we've seen some put writing as well. For the Nifty, yesterday, the up move saw some calls covering their position, the call writers covering their position, and now we have put writers back in the market. So 26,000 put writers fairly active, 25,950 put writers also active, telling you support has come higher from the lows that we saw on Monday, and 26,050 call as well. That's a little active right now in trade. Maybe the bulls want to get a sign of confidence that the market is going above, so which is why we need to cross past the 26,050 to 26,100 mark before we move further. So once that happens, maybe we can see some of the other index future shorts cover their positions as well. The Nifty put call ratio is at 1.14. That's telling you that we're slightly at the higher end of the range so far after having seen a bounce. So moderation out there would be good for the bulls as well. A lot of longs are added on GMR Airports and PNB Housing Finance. So those are a couple of stocks we're watching. Long positions unwound in Siemens after the management commentary on their DI pipes came in. And finally, a couple of these consumer names are seeing a lot of shorting activity. HUL, unusually high open interest build up on that counter. And Jubilant Food Works as well is seeing some shorting.
Thank you very much for that. On that note, we will slip into a very short break. We'll come back with more on the market. Stay tuned.
Years of CNBC-TV18.
Welcome back. What a day for metal stocks. Really, anything and everything is going up. There's also GMDC, by the way, that is now up 5%. And then the usual winners like Hindustan Zinc, which we have been discussing. That's the Nifty Metal Index. Solid gains seen this week. We've got Mitesh Thakkar joining in with some final trades and ideas. Mitesh, before you get set for the weekend, what are the final calls?
I think, one good thing today is that the closing is pretty positive, and, we haven't seen the market kind of come off despite the fact that we are closing about 26,000. So in that sense, we'll take some positive trades. Bharat Forge is a BTST with a stop at 1419 for targets of 1450. And the other one is BHEL, which is the BTST with a stop at about 282 for targets of 290.
Thank you very much for that. Let's get back to the silver rally that continues at a sizzling pace. The metal has now hit a fresh record high above $64 an ounce. And in rupee terms, Manisha, it's crossed 2 lakh for 1 kg. Tell us more.
Oh, well, yes, it's been one unstoppable rally is what we have seen. Most people believe that once we hit December, perhaps the volumes will go down. You'll see those book closures happening and people might want to go out and take profit. But there's nothing like that until now. So 4% of gains in overnight market is what we saw in case of silver. It is up 22% in last 1 month and 122% up in dollar terms. And it's 128% higher in the Indian markets right now. So, well, yes, with the kind of gains that we have seen at 2 lakh rupees a kg in case of silver, we clearly are looking for the best annual gain since 1979 for silver prices there. Well, it's trading at record highs, not just in US or India, but in various other countries like China, Germany, Australia, and I could go on with that list. So silver has been hitting record highs in various other currencies as well. Well, the precious metals also are advancing because of treasury yields declining. You have the dollar index, which is trading at an 8-week lows. We've seen 8.5% of a decline come in for dollar index. That has been supportive. But the latest cues clearly came in from the US Fed meeting, where they're talking about expanding their balance sheet, also by buying nearly $500 billion of US dollar. And that really seems to have hit that QE mindset into the markets, leading to buy in case of silver and gold there. Then you have seen strong industrial demand coming in. The investment demand in the Asian markets, especially India, has been very, very strong. Physical buying, ETF buying is in thousands of tons, and that has been supportive. US also has added silver to critical mineral list. You have China statement suggesting that they will restrict exports from 1st Jan 2026. So various countries also now talking about silver, putting in fresher reforms there and monitoring prices and movement of silver in the global markets. All of that clearly supporting silver, with markets anticipating you could be looking at 65, even 68 for that matter before this year ends.
Thank you very much for that. Gurmeet Chadha, Managing Partner, CIO, Complete Circle, joins in for the last leg of Friday's trading session. And markets gain still going strong, up 0.5%, and the Nifty is now closer to 26,050. Gurmeet, Hindustan Zinc, that's clearly the stock of the week.
Yeah, a clear rub-off happening on what's happening in commodities, especially silver. Unfortunately, we don't own it. We tactically are positioned in Hindalco, a little bit of Tata Steel, and there's a special situation play called Mukund Limited, which is more stainless steel. So playing it tactically. But yeah, great move. But we've been doing a lot of gold, silver ETFs for some of our clients. So small participation that way.
Do you think the gold and silver rally continues, or do you think it's sort of toppish now after this kind of an up move?
I don't think so. The risk reward at this point of time is very favorable in terms of incremental allocation. But the fact that the PFRDA has been allowed to add gold and silver, a lot of central banks have expanded their investment framework in terms of adding precious metals. So this is basically a huge demand letter. And there was globally JP Morgan, which was initially short and then added silver contracts. So a lot of, but metals, mind you, can correct very sharply. And silver also has history of doing that. So just be a little careful. Don't, we tend to get carried away seeing last 6 months, 12-month returns, which have been very, very good. So use it as hedging to any global uncertainty and not right now in terms of incremental portfolio allocation as far as, my thought process is concerned. But, I can be wrong on this.
So that's gold and silver, Gurmeet. But overall metals, I mean, the rally is going through the roof, literally. And I mean, the commentary is also turning positive, even on a lot of base metals, right? Copper prices anyway have been rising. We know that. There's some chatter that maybe aluminum will keep seeing better demand and less capacity. I mean, would you read in too much, or is this just a sentiment rally?
Yeah, it's as you said, so it's a bit of a rub-off post-Fed commentary, and people were thinking it is a hawkish cut. It wasn't really a hawkish cut, although there are different views on it. And the fact that the QE has started, they're buying billions of dollars of treasuries, and in this kind of environment, commodities, especially precious metals, tend to do well. So, as I said, play tactically. Get into the names, but do not make it a core part of the portfolio. These things can reverse, and let's say if there is and I hope there is a Russia-Ukraine peace deal, any risk off which happens, then you might see very sharp correction as well. So just be mindful of that. So if you want to do incrementally, I think just wait for any good risk off events so that you can get better entry points.
Gurmeet, stay on. We'll come back to you. For now, we need to slip into a very short break. 9 minutes to go before we wrap up the day and the week.
Welcome back. 150 up on the screen, and it's a green looking screen. Look at that. That's a good feeling to go home to over the weekend, given the market action today. We still have Gurmeet. So, Gurmeet, I mean, what's your sense? It's, the bulls are not giving up. That's the good part, right? They're fighting back. So, any new ideas? And I know we've discussed these EMS stocks, and you've been maintaining anyway that they got very expensive. You've owned them in the past. But what did you think of this whole Keynes situation and the way it hurt PG and, Dixon and the others? And what would your advice be to people now?
So, Surbi, I think there's a lot of pain in the broader market, and the portfolios are more like 2,500 on the Nifty, and the index keeps scaling back. So I think some of the EMS names, they were priced to perfection. And when you're growing at 30-40% quarter on quarter, the market then gives you price to governance. And any lapse in that, whether it is disclosure, whether it is any related party transactions, the market is not kind because, you're valued at 100, 150 times or 6-7 times sales. So I think that's what exactly happened. And there was a rub-off which happened. But I think this is a structural story. If Keynes can demonstrate 1 or 2 quarters more in terms of, continued good performance, especially on the more progress on the OSAT plant, which they have on semiconductors, and improved disclosure, they've already changed the auditor. I think these things take time, but can come back. So overall, we were buyers. We actually bought a little bit of Dixon and Keynes because I missed out on Keynes earlier, as I said earlier. So we slightly added it, but I would wait for 1 or 2 quarters for things to go up. So I'm very constructive on this space as well as the semiconductor space.
No, absolutely. Gurmeet, hi, afternoon. ICICI Pru, any thoughts? The IPO?
Oh, all AMCs, Prashant, I keep saying this is an infinite ROE business. Look at, for example, HDFC AMC, 50 crore, 100 crore authorized capital, you make 3,000 crore PAT. So the cost doesn't go up once you cross a critical level. So I think we'll do well. So, like HDFC, like Nippon, will do well. I think some of the other AMC's names, the valuations are literally half of what HDFC, and eventually I think ICICI will also list well trade at. So let's say, for example, Birla, post Harish joining in, the equity funds have seen quite a bit of a turnaround. and some of the debt issues they had on credit sides are behind. So that looks very reasonable. So some of the AMCs like Birla, for example, the valuation comfort is there, but this space will do very well. And this is a high beta space. Once market recovers, so not only it recovers with the market, it then tends to better because of the fee they make on an MTM basis.
Okay, all right, Gurmeet, thank you for all the perspective and the advice. With that, we'll let you go and start your weekend. Have a good one, and we'll catch up again soon. Almost time for the bell. So let's recap what's been a solid day and a good comeback by the Bulls today. 150 on the Nifty, and it's a very well-rounded screen, like I've been saying. A lot of participation from metal stocks. So the winners are Tata Steel and Hindalco, even JSW Steel. These stocks have gained between 1.5% to 3.5% in some cases. There are some consumer names on the upside. There is Eternal, for instance, there's Nestle. That has had a pretty good day. Maruti is also an extended format of consumption, is about 2 to 2.5%. L&T got a good boost from that Goldman Sachs report. Goldman Sachs thinks that 5,000 is a possible target on Larsen & Toubro. Bharti Airtel, Grasim, Apollo Hospitals. These are the winners of the day. Some of the financials, Bajaj Finserv, Axis Bank, so some of the financials managed some green. By the way, Interglobe Aviation today is up 1%. For the week, it's 10% lower, with that whole fiasco playing out. Question is whether the worst of it is over or not. But that's what it is. Today, it's up 1%. On the downside, HUL, Sun Pharma, Max Healthcare, and Asian Paints are some of the weak names. But I guess, Prashant, the sector of the day definitely was metals. Whether precious or otherwise, metals all the way.
Metals all the way. I mean, and I think the stock of the week was, in a positive sense, but negative sense was Indigo, right? 10% down this week. Just want to take a quick look at what it did today.
Today was up 1%. Finally managed to 1%.
So as we ended the week, it started to, actually yesterday was up quite a bit of recovery from the day's low. And today also trying to make a bit of a comeback here. Markets basically trying to sense whether there is more in terms of some penalties, etc., coming Indigo's way, or what we've seen is it. That's all. Asian Paints was the other one, which was down 7% for the week. And actually, on the upside, of course, Hindustan Zinc, 14%, by the way, for the week. The ADAG group companies had a bad week. The top losers from a basket of NSE 500 is Reliance Infra and R Power, 12 and 9% down, respectively, for the week. So, just a overall sense in terms of what we saw. So about 0.6% lower on the Nifty, about 0.75% lower on the Nifty Bank. Mid and small cap indices down 0.75%. That is the tally Friday to Friday. It's a wrap on this edition of Closing Bell. From all of us here, goodbye. Thanks for staying with us. Editors Roundtable up next.
"26 years of CNBC TV18